In March, Tesla boss Elon Musk announced unexpectedly that the electric car maker would allow customers to buy cars using Bitcoin. But after a few months, he did a U-turn and suspended vehicle purchases using Bitcoin because of environmental concerns. His fears center on Bitcoin mining, the energy-intensive process through which the digital currency is generated. Using high-powered computers, it often relies on electricity generated with fossil fuels, particularly coal. We're concerned about rapidly increasing use of fossil fuels for Bitcoin mining and transactions, especially coal, which has the worst emissions of any fuel. Cryptocurrency is a good idea, but this cannot come at great cost to the environment, Mr. Musk wrote. He said the electric car maker did not intend to sell any of its Bitcoin and intended to reinstate cryptocurrency transactions once mining shifted to using more sustainable energy sources. Although the digital currency cannot be traded in China, more than 75% of Bitcoin mining around the world is done in China. China's relationship with cryptocurrencies has been a turbulent one, with several crackdowns since 2013 affecting the values of the digital coins, including Bitcoin, with ripples felt across the world almost once every bull cycle. This month, Chinese regulators banned the country's financial institutions and payment companies from providing services related to cryptocurrency transactions, while also warning investors against speculative crypto trading. The new restrictions add on to previous bans that have limited the use of Bitcoin and other cryptocurrencies in the country, the first of which can be traced back to 2013. Interest in Bitcoin skyrocketed in China in 2013 following nationwide media attention to a fundraising event along with the founding of the crypto exchange Huobi and mining hardware manufacturer Bitmain. Through most of 2016, Bitcoin prices rose again in China amidst a weakening yuan, but the country's regulators swooped in again and banned initial coin offerings (ICOs) in September 2017 to protect investors and curb financial risks. The committee that advised this 2017 ban expressed concern that some ICOs, which are fundraising platforms that help in creating and selling new crypto tokens, could be financial scams and pyramid schemes. In the subsequent months leading to January 2018, the moves reportedly led to a 65% crash in BTC price, and 90% of blockchain-focused venture capital firms in China left the market. According to the People's Bank of China, PBOC, close to 90 virtual currency trading platforms and 85 ICO platforms had left the market by July 2018. Then starting from 2019, the Chinese government also began stressing the importance of blockchain technology, even initiating plans to set up its own central bank digital currency, CBDC. The PBOC set up the Digital Currency Research Institute to conduct research in digital currency and study tools like blockchain and the distributed ledger technology, DLT, to help implement CBDC. Now, the latest ban comes after a week of decline in values of several cryptocurrencies, including Bitcoin, following a global BTC bull run. Recently, cryptocurrency prices have skyrocketed and plummeted, and speculative trading of cryptocurrency has rebounded, seriously infringing on the safety of people's property and disrupting the normal economic and financial order, the regulators noted in a joint statement on Tuesday. The current directive could make it more difficult for people to buy cryptocurrencies in China and may throw more hurdles for miners to exchange cryptocurrencies for yuan. But some investors say this is part of a once-in-a-bull cycle ban that the country enforces on the digital currency. On May the 18th, 3 Chinese industry groups overseeing the financial sector announced the country would crack down on financial institutions conducting cryptocurrency business or offering related services in light of the market's volatility, saying digital tokens have no real support value and prices that are extremely easy to manipulate. The following week, Beijing said it would clamp down on Bitcoin mining and trading activity to achieve financial stability by curbing the spread of cryptocurrencies. In addition to Qinghai, 2 other provinces, Inner Mongolia and Sichuan, have since announced policies to curb or ban mining. Markets plunged about 30% amid the warnings and have since added back about 15%. On Tuesday, 3 state-backed organizations, including the National Internet Finance Association of China, the China Banking Association, and the Payment and Clearing Association of China, issued a warning on social media. They said consumers would have no protection if they were to incur any losses from cryptocurrency investment transactions. They added that recent wild swings in cryptocurrency prices seriously violates people's asset safety and are disrupting the normal economic and financial order. Neil Wilson on Markets.com said, China has for some time been putting pressure on the crypto space, but this marks an intensification. Other countries might follow now as central banks make strides towards their own digital currencies. Until now, Western regulators have been pretty relaxed about Bitcoin, but this might change soon. China just cracked down on privately mined cryptocurrency, and we saw the market for Bitcoin fall down a cliff. In an international context of economic instability due to the continuing coronavirus pandemic, skyrocketing commodity prices, and geopolitical tensions, the People's Bank of China has emphasized its orientation toward financial, employment, trade, and investment stability. Another major tenet of Chinese financial policy has been an emphasis on finance serving the real economy. Cryptocurrencies have shown enormous volatility in recent months and a growth trend that suggests a bubble. The value of Bitcoin has risen by 300% over the last 12 months. The European Central Bank has warned of a cryptocurrency bubble that has outgrown comparable financial bubbles in history, including tulip mania in the 17th century. Aiming for stability and for a financial architecture that is geared toward supporting rather than dominating the real economy, it should come as no major surprise that Chinese authorities have restricted cryptocurrencies in order to prevent an economic shock if this bubble bursts. The most recent announcement of the ban on cryptocurrency services stated that Bitcoin is a specific virtual commodity that is not issued by a monetary authority, has no monetary properties such as being legal tender, is not a real currency, and should not and cannot be used as currency in the market. A move by Chinese regulators early Wednesday to restrict crypto activity may have helped spark a broad sell-off for digital assets, but the crackdown, which appears aimed at bolstering the country's own digital yuan efforts, could backfire, says one analyst. Although China represents as much as 75% of all Bitcoin mining, the Chinese government is clearly averse to seeing Bitcoin's rise in popularity as a medium of exchange, said Boris Schlossberg, managing director at BK Asset Management, in a note. Instead, Chinese authorities are keen to see their own digital currency in the form of the yuan become the primary unit of account in the Chinese economy. The People's Bank of China announced that financial services companies and payment services were banned from pricing or conducting business in virtual currencies, news reports said. That was one factor widely blamed for a sell-off that saw Bitcoin BTC USD minus 2.98%, the world's most popular digital currency, drop toward $30,000 at its low on Wednesday before rebounding back toward $38,000. It's still nursing a loss of more than 10% on Thursday and is well off its all-time high above $60,000 scored earlier this year. Other popular digital assets, including Ether, ETH, USD, minus 4.16%, and parody crypto Dogecoin, Doge USD, minus 3.40%, also fell sharply. Bitcoin mining consumes an estimated 128.84 terawatt-hour per year of energy, more than entire countries such as Ukraine and Argentina, according to the Cambridge Bitcoin Electricity Consumption Index, a project of the University of Cambridge. China accounts for around 65% of all Bitcoin mining globally. Inner Mongolia alone accounts for about 8% due to its cheap energy. In comparison, the United States accounts for 7.2% of global Bitcoin mining. Not all cryptocurrencies work like Bitcoin, however. Inner Mongolia, located in northern China, failed to meet central government assessment targets regarding energy use in 2019 and was scolded by Beijing. In response, the region's Development and Reform Commission laid out plans to reduce energy consumption. Part of those plans involved shutting down existing cryptocurrency mining projects by April 2021 and not approving any new ones. They also involved reassessing other energy-intensive industries like steel and coal. While the Chinese government has backed the development of Bitcoin's underlying blockchain technology, it has looked to crack down on digital currencies themselves. In 2017, Beijing banned initial coin offerings, a way to issue digital tokens and raise money. The government has also cracked down on businesses involved in cryptocurrency operations, such as exchanges. China is also pushing to become more environmentally friendly. President Xi Jinping said last year that the country is targeting peak carbon dioxide emissions by 2030 and carbon neutrality by the year 2060. What is your opinion about China's action? Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel, hit the bell icon for more updates and notifications. Stay safe, and we'll be back soon with another video.